Hey traders, Marcello, founder of the Day Trading Academy. Today we're going to be talking about how to create a day trading strategy. We're here in our trading center in Medellin, Colombia. This is where we do our training. We have our traders come, we do events, we hang out with the ladies in Colombia. So let's go to the computer and I'll go ahead and get started.
Hey traders, Marcello here, founder of the Day Trading Academy. Wanted to do a quick video. I got some questions from some of you guys about how to create a trading strategy. Obviously, I already did the introduction. I have here the charts. I'm going to show you guys kind of a little bit of what we look at, how we look at it. Obviously, I do want to be upfront with you guys that you can learn how to trade for free if you want to. Obviously, it's a matter of time versus money. If you don't have to spend $10,000 to learn how to trade. If you're going to learn on your own, you can do it. It's just a matter of the amount of time that it's going to take you to kind of sift through all the keyboard warriors online. Oh, this guy's great, this guy's a fraud, this is great, this is that, and obviously combining things. So I'm gonna try to explain to you guys how we do it in a way, and also allow us to kind of explain it to you a little bit. Okay, so there's two very key steps in having your own plan, and what I consider to be very, very important, and something that's absolutely critical when it comes to being able to create your own strategy. You have to win more than you lose, okay, which is obviously more than 50%, and this isn't always, this is just on average. And then two, you want to make sure your winners are larger than your losers, which means that you want a minimum, I would say, of about 2 to 1 reward to risk ratio. And I know I spelled minimum wrong there. You guys will have to bear with me. Reward to risk ratio. So basically what that means, if you're going to make $200 on a trade profit, right, you want to make sure that you lose less on average than about $100. The only other thing that I consider to be very, very important is obviously the ability to adapt to what the market is doing, but you want to make sure that you're looking at the market in a way where you're not necessarily quote unquote trading with rules-based trading, but you're trading with areas of high probability, right? So I'm going to write just high probability areas. So the more areas that you have, the better it is. And then once you get to the point where you can understand market structure and market behavior and those little kind of nuances of the market, every single market has a specific personality. So, obviously I don't like Forex. In my humble opinion, it's the absolute worst market to trade. Well, actually, that's not true. I think binary options and probably CFDs are the worst. But I honestly consider that stocks and futures are the best markets to trade. I personally believe that futures is the actual best. I've been trading futures, or I've been in the industry for almost 16 years now in some capacity, right? Learning, teaching, trying to fund traders, learning how to trade, actually trading, all that good stuff. So when it comes to high probability areas, the more areas you have, the better it is to be able to trade with. And if on top of that you have good movement or good market structure or good momentum in a certain direction, obviously it's going to be much more important. So just to kind of take a look at the chart that you guys are seeing here, right? Obviously, from the yellow line to the right, this is the new day, which starts at about 6 p.m. Eastern time. That's when the futures market's open. It's open about 23 hours, 15 minutes out of the day, except for Saturday. It's the only day that closes. Very similar to Forex in that it's almost open 24 hours a day. And so you can see that the market literally starts off to the downside here, right? So we can start to look for areas, and obviously I'm not going to bore you guys with how to figure all this out, because I think if you guys are watching this video, you know, you're probably either already trading or looking for consistency, or probably looking for a few tidbits of kind of information to be able to use. So you can see that we have a few areas here that the market's respecting overall. We have this area, we have that area. You can see it on the downside here as well. We have this area, so you can see that we have a micro trend in the grand trend that we have. So we call this, obviously direction, which is down, and then we have overall momentum, which is the general direction or the strength of the market. So looking at the areas, you can see that we have these areas that the market's respecting even here, right? If I extend this line, notice how the market really respects it all the way down to here. This can actually be just a little bit higher, right about there. Notice even here it overruns it a little bit, and then it continues down, right? So, and I'm going to show you guys something else here as well. Let me extend this to the right, and look at how the market literally continues to respect it as well down here. So if we're going to take a trade, or if we're going to look for opportunities, we obviously want to make sure that we look for areas, or the highest probability areas. We already have, for example, here a trend line, right? We can look for areas, which is literally support or resistance, right? And obviously we have here, for example, a resistance area right about there, right? Somewhere in there. Could be a little bit lower actually. So now we have two areas. On top of that, we have retracement zones, Fibonacci retracement zones. Notice here we have a 50%, literally how it touched the line. We can take a much bigger retracement. Notice how we have kind of confluence now. We have the 50% and the 38.20%. So literally these things start to add up, and we start to look at these areas where we can look to take trades, basically, right? So I'm going to write fib zones here. You can do all kinds of different areas. We can use, anywhere between 7 or 8. So if we're going to look to take a trade, right, remember that the market literally works with areas and not necessarily with exact prices. So literally the market can literally get to right here. So if we're going to risk a certain amount on this trade, let's say, for example, 2 points, right? If I look at this, we're going to need to gain, I would say, a minimum of 4 points. So that's 1, 2, 3, 4, right? In order to go ahead and look for that opportunity. And literally you can see how it actually lines up. Yeah. Now, one of the things as well is we're looking at this live. So this literally looks like this. And we can literally get to other areas. For example, this trend line is the area that the market's respecting on the downside. So this is the area that really the market should get to. And notice how it's literally just a little bit lower. I just moved that line by accident, so literally just a little bit lower. So literally we're now at 3 to 1, or 4 to 1, whatever the case may be here. And obviously as the market moves down, notice how we're literally much lower where the market actually should get to, right? Because now we should actually get to here. So now our trade is literally turned into a risk reward, or I could say it backwards, or reward to risk ratio of 2 to 1 to literally 3 to 1 or 4 to 1, right? And obviously those are the kinds of odds that most traders like to have, because we really shouldn't be as ignorant to believe that we're going to win all the time, right? It's very important to understand that traders lose. It's a lot easier to lose than to win. So we have to make sure that we put ourselves in the best situation possible with this, right? Win more than we lose, winners higher than losers, and obviously trade with higher probability to make sure that we have the best opportunity to win. So another thing I want to show you, and without kind of seeing where the market goes here, if we look at Fibonacci extensions, this is actually one of my absolutely favorite things, right? If I take an extension here of these areas, there we go, something like that. These aren't going to be exact, because obviously I'm not looking at the exact prices here, but something along these lines. Notice how we start to have these areas kind of follow each other. So notice how here we have a cluster, right? We have a confluence of fibs. Notice how here we have a confluence of fibs. If I go a little bit further down, notice how we have another confluence of fibs down here, right in this area. So I'd be willing to bet if the market keeps breaking these areas, it's going to get down to here. Notice, look at where it got to, right? And obviously from here it can continue going down. It gave us a deeper retracement, and notice the next area was literally hit. See the confluence zone down here? So this is where we can start to add all of these areas up, right? And if we do this as if it were live, so to speak, right, it's really easy to talk about the market after the fact, right? And say, well, yeah, of course I should have got to this area. Of course you could have made $1 million yesterday, right? Notice how this is the area we were looking for, and now it coincides with that area of the confluence of fibs. So we start to have these areas of high probability to be able to make sure that we can start to look for these areas, especially when we have market structure and behavior to pay attention to. You know, other than that, and I think a few things that are important to note, that we shouldn't automatically assume, right, that we are going to have awesome markets all the time. Because obviously if that was the case, then everybody would just be a millionaire trading, which you know, obviously is not true. So we're always going to have these range of movements where, you know, we're going to have, on the bad side, we're going to have bad volume days, or, you know, the summer where kind of the volume and volatility slows down. I'm recording this video on the 15th of August 2017, and in the summer of 2017, July specifically, I would say the last few weeks of July and the beginning weeks of August, the market had the lowest volume and lowest volatility on record and history of the stock market. We obviously have good markets, you know, the crazy moving markets like Trump and Brexit, and really high volume markets when we have really good overall momentum. So one of the things to really understand about these markets is we're literally, I would say, going to get these markets anywhere between 20 to 20% of the time, right? And over here as well. And obviously in between, we can have anything like erratic markets or a combination of all these. So if we're going to be able to make money consistently, because remember, trading is not about making $1 million. Trading is about being consistent. So even if you just start making $1 a day, eventually that will turn into $2 a day, and then that will turn into 4, and then 8, 16, 32, 50, 100, etc., etc. So we have to make sure that we can make money in any kind of market, right? Not just try to make $1 million on one clip, which is the majority of you guys consider how to actually make money. So, you know, even though, you know, this is an example of a positive trade, you know, we can talk about other situations where, you know, yeah, this would have been a winning trade, but for example, this one over here was definitely a losing trade, because notice it didn't get to the overall area that we would have been looking for, and that could have been a loss. So it's important to really understand that trading is psychological more than anything, and obviously we shouldn't be ignorant to automatically say that the market is always going to move the best that it possibly can all the time. So this is one of the reasons why we use tick charts, which is the charts that you see here with the black bars and the dots. This is the actual price of the market, right? And so by seeing this, we're able to actually see the behavior or the structure of the market, right? If you guys use candlestick charts, no matter how much volume there is, you're always going to see 8 bars of 60 minutes, 16 bars of 30 minutes, 48 bars of 10 minutes, etc., etc. Whereas if we look at tick charts, you know, depending on the day, we see a lot more volume and a lot more volatility depending on the day. I think I'll go ahead and close the video here, guys, with that. I hope you enjoyed kind of this different style. I wanted to do this video because some of you guys were asking, you know, how do I create my own strategy, or how do you use the strategy that you guys use, which we call congressive? Because obviously here, for example, in these bad moving markets, what we try to do is we try to be conservative, right? But in the good moving markets, obviously we try to be aggressive. And so, you know, we literally call it congressive because we have to adapt to what the market is doing. So let me know if you guys have any questions. You can mark all the questions with hashtag Ask Marcello. I'll be happy to pull all the questions for you and answer them. Other than that, don't forget to subscribe, and we'll talk to you guys soon. Ciao.
Like all the coaches out there that do trading, right?
Oh yes, you can make $1 million if you buy here. Oh yes, of course. Well yeah, just buy there. Yeah, you can make so much money. Oh yes, follow me, my system. Oh, it's so perfect. Oh yes.